Happy Friday to you. My name is Jason Watson, Watson CPA Group. Might not be Friday where you are today, but today it is Friday for us, so we're really excited. We're also really excited about this concept called net zero checks. And yeah, we got debits and credits and T accounts and right? My wife Tina, when she was in CPA school, thought that they called T accounts after her. So anyway, a little bit of accounting humor. So we're going to run through some of this stuff from a business owner perspective. We're going to geek out a little bit, okay, with debits and credits, and shall your debits and credits forever equal, right? So net zero check, let's discuss this for a little bit. When you work for somebody else, you have to wait for payday, right? And you got your bills, you're trying to time your bills with your paycheck and all that stuff. As a business owner, you sort of have access to cash before payday, right? So with why waiting for cash concept, we want to talk about distributions, right? So remember, as an S Corp, you are wearing two hats. You are wearing the employee hat, and that's where wages come in, and you're also wearing the investor hat, and that's where distributions come in. So as an S Corp owner, you're pulling cash out in two different ways. With distributions, we want to caution everybody, don't use your business checking account as your savings account, your piggy bank. You want to leave enough cash in there for operational considerations, future bills, future capital expenditures, but then after that, you need to take that as a distribution. So we suggest doing a systematic distribution, whatever that amount is, right, according to the cash that you have available. Also, I want to make sure you know ahead of time, this video is long. We're trying to time it about 5 or 6 minutes for most of our videos. This might be 10 or 12. So if you want to pause and go to the restroom or get some fresh coffee, now's a good time. Systematic distributions. Maybe every month you draw out $10,000. Maybe you draw out, whatever, something along those lines. Then after maybe each quarter, you do an unscheduled true-up distribution, okay? So maybe you're sitting there in April, you got done doing your systematic distributions for January, February, and March. You're sitting in April going, you know what, we have some extra cash. Okay, cool. Take that excess cash out as an unscheduled true-up distribution, okay? So now, we still have to do this payroll thing, right? The IRS forces us as S Corp shareholders to pay ourselves a reasonable salary, and we have a whole nother video on that as well. So let's say we've determined the reasonable salary and we're doing all this stuff. What we do then is reclassify prior distributions as salary, and that's where we're going to kind of discuss this over here. Okay, so we're going to take our prior distributions and re-identify them, reclassify them, that's the words we use, as salary, or at least a chunk of that as salary. Here's an example of a $10,000 salary, right? We would need about $10,800 in cash, maybe a little bit higher, depending on your state in SDI and other insurances and things like that. The 800, generally speaking, is going to be the company's segment or component of Social Security and Medicare taxes. This would, and again, we're guessing on your federal income tax withholding and all that stuff, this would maybe be about a $6,000 net check. Okay, so for you to get $6,000 from your company, you would have to have $10,800 in cash to run the payroll. So what we do with this net zero check concept is we deduct $6,000 as an advance. We take this net check figure, whatever that is, and we deduct it as an advance because you really had some advances here as distributions, right? So then what this means is all you need is $4,800 in cash versus $10,800. What's the benefit of this? The benefit is just allows you to run leaner in your business checking. You don't have to have a bunch of cash in your checking account and wait for payday to take that money. Take that money now. Leave enough behind, right, to cover the taxes of your payroll, but the rest of it you can take as a distribution. Okay, so zero checks allow you to have lower cash needs. Before we get into the exceptions, okay, let's kind of go over here to the accounting side of the board. So throughout the quarter, let's say you took out $40,000 in shareholder distributions. Shareholder distributions is a debit account, okay, in the equity section of your balance sheet. So the equity section is generally credit, 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 and then a debit or shareholder distributions is going to be a debit account reducing equity. That kind of makes sense, right? Because you took cash out of the business. So we debit distributions. When cash leaves your body, that's actually a credit entry. So here we are with our shareholder distributions and our cash entries. When we go to reclassify prior distributions, what we're doing then is we're debiting wages. So when we debit an expense, that adds to the expense account, and we're crediting distributions. Okay? So what we are going to end up looking like is $40,000 was debited throughout the quarter. We have a $10,000 entry here, and then basically your distributions were $30,000. So we took out $40,000 as distributions. We reclassified some of those distributions as shareholder wages, reducing the amount that was associated with distributions to $30,000. So what this whole system allows you to do is take cash out as you need it systematically through distributions, and then we go back in time and re-identify, reclassify some of those distributions as wages. And again, having that net zero check just allows you to have less cash in the business checking account. Now, there are some exceptions to this, okay? If you have a staff, we can certainly just work your net check in with the staff. That way, you know, your cash needs every 2 weeks are fairly consistent. You don't have this big chunk coming out just for you, kind of even out your cash flow. If you have other partners in your S corporation, so let's say you and I are 50-50 in this S corp, we're both getting a salary of 50 grand a year, whatever that might look like. We want net checks, okay? And we can explain to you why that is. It's probably beyond this video, but that's another example of when you want to have net checks. The last exception is you're freaking out, like you don't like this idea, okay? And we leave room for this not being for everybody. So yeah, if you're like, no, I really want that $6,000 check every quarter or every month or whatever it is, fine, of course, that's fine. It's your business, you can run it the way you want. We suggest exploring this though, just minimize cash needs, also allow you to be more flexible with your cash, take the money out as you can, and then we go back in time and re-identify those, some of those distributions as salary. So anyway, the net zero check concept, kind of interesting, blows people up at first, but we find that after you do this a couple of times, it makes a lot of sense. We're more than happy to walk through this with you, discuss it with you, send us an email, call us up, we can run through this again, as I said. My name is Jason Watson with the Watson CPA Group. Thank you.